Hi class, this video is going to be an introductory video to depreciation. If you're wondering where you'll find information on depreciation in your textbook, it is actually a rare one that is over 2 chapters because we're going to learn 2 types of depreciation. Straight line depreciation, chapter 15, reducing balance depreciation, chapter 16. What is this video all about? This video is all about an introduction to depreciation. So by the end of this video, I hope that you are able to describe depreciation and define depreciation in terms of straight line and reducing balance, and you get an understanding of the meaning of the costs relating to non-current assets. Other videos are going to really talk about how we record depreciation using straight line and reducing balance in our journals, ledgers, and reports. So this is really an introduction, the first one you should be watching, so we are all on the same page, understanding what depreciation is, which of these methods do we apply, and what do we need to be considering when we look at depreciation. So what is depreciation? Depreciation is the allocation of the cost.
Mr. Dudley.
Depreciation is the allocation of the cost of a non-current asset over its effective working life. So we are always talking, when we talk about depreciation, non-current assets, assets that we're going to hold for 12 months, and we are going to allocate a cost over its working life. We know that we are going to allocate the using up of this asset throughout its life because we're going to hold it for more than 12 months. So why do we depreciate? The purpose of depreciation is to write off part of the cost of an asset against the revenue generated by that asset. Therefore, depreciation is an important expense and should be considered under accrual accounting when determining profit for a period. So let's break this down. When we're talking about depreciation, as I said, we're talking about non-current assets. We are going to use these for a number of years. We are going to, however, generate revenue through that asset each year that we use it, and we're going to essentially start to use up the worth of that asset. Because we're going to hold it for more than 12 months, we have to recognize through depreciation that we're using up some of the use of this asset each period, and this is what I mean by depreciation. We're allocating a cost of the non-current asset each period throughout its effective working life. So before we do this, before we allocate a cost for each period, we really need to do some revision on what I mean by the cost of a non-current asset, because that's the starting point. How much is the cost, how much is our non-current asset worth when we purchase it? Because only then can we start to allocate parts of this cost to each period. So this comes back to terms and concepts that we've learnt before. We need to understand that the non-current asset will be valued at its purchase price, what we buy it for, but importantly, plus, circle that plus, all other costs incurred to get the asset into a revenue earning capacity. Simplistically, all other costs to get it into the condition and location for it to earn revenue. So this is going to include, as well as the purchase price, terms that we've seen before. Freight in, modification or installation costs, custom import or stamp duties, other buying expenses, and it does, however, exclude these recurring costs. So registration or insurance, these are period costs. These are not to get it into a revenue earning capacity. These are things that keep recurring while we use it. So as always, examples are really good to understand the concept. So let's look at one so we can, and why do we do this? We do this because it meets the qualitative, faithful representation and reliability characteristics. We want to understand and faithfully represent how much our assets cost, and we want it to be really reliable. We get this and achieve the verifiability assumption because we're getting all this cost information from a source document. Importantly though, as I said, it's all about examples for understanding this, so let's go through one. What is the cost of this non-current asset? So we know they should be valued at its purchase price plus all other costs incurred to get into the asset into a revenue earning capacity, so the condition or location. So let's look at this example. A business buys a new vehicle for $20,000 cash, that is its purchase price, and pays the other items listed in the table below. Government stamp duty of $1,000, dealer charges of $500, and then insurance and registration of $800 per annum. So we need to identify, and I'm going to get you to pause the video and work this out, which ones of these costs need to be added to the purchase price because they're to get it into the revenue earning capacity, and which ones are recurring costs. Pause the video and try and work out what you think the cost of this vehicle is. Hopefully, you've come up with the answer $21,500. We add the stamp duty and the dealer charges to this purchase price of this vehicle to get its cost. All the other items, including their insurance and registration, are period costs as they are recurring. And you can see that there is a more detailed answer on this slide, which might make sense to pause and have a read of. But the important bit, identify recurring costs, remove them from the cost price, add all the other costs to get it into revenue earning capacity. So before we start to look at straight line depreciation and reducing balance, there are some key terms that you need to know, need to understand, need to use these in answers and really understand the meaning of these. I'm going to be talking about depreciation expense in videos, and you're going to see this in your questions. What do I mean by depreciation expense? This is where we measure the amount of the non-current asset that is being consumed in the current reporting period. How much of this asset has been used up, how much of its value has been used up in this reporting period, we will make this an expense. Accumulated depreciation is a negative asset account which records the total depreciation charged against an asset at a point in time. So for example, if I understand that there will be $1,000 depreciation expense each year, $1,000 of the non-current asset is consumed each period. After 3 years, I have $3,000 of accumulated depreciation. I have accumulated $3,000 of depreciation, which has reduced my asset by that amount, hence it is a negative asset account. And we're going to go through these in more detailed examples in future videos. Carrying value is the value of the non-current asset that is yet to be consumed or allocated. So if I have an asset worth $10,000 and I've used up through accumulated depreciation $4,000 of it, I have $6,000 left of carrying value of the non-current asset. So what are the types of depreciation that you're going to come across in this unit? You're going to come across straight line depreciation and reducing balance. Straight line depreciation is a method of depreciation that allocates the same or constant amount of depreciation expense for each reporting period, regardless of the age. For example, if I have an asset that has depreciation of $1,000 per year, it is a straight line. It is a constant amount of depreciation for each year. Reducing balance is a method of depreciation that allocates more depreciation in the early years of its life and less depreciation in its later years. It is not constant. Graphically, it can be shown like this. Figure 15.7 shows the depreciation expense per year. You can see reducing balance has a higher amount at the start and gets lower as we go on because they allocate more depreciation in the earlier years of its life. Straight line is the same. It is a constant amount each year. Carrying value, the value of the asset, is different. Because it is a constant amount of expense in straight line, the value of the asset reduces constantly, the same amount per year. Reducing balance, because we have more depreciation at the start of its life, is going to have a reduced carrying value compared to straight line at the start. But this gap is going to close as it has less and less depreciation per year compared to straight line depreciation. Again, these are the theories. Examples will make it clearer. So which depreciation method to use? The last part of this video. When selecting a depreciation method, you should always consider the revenue earning pattern of the asset. Remember, depreciation is our estimate of how much of the revenue earning capacity has been used up in a period. So we have to consider the revenue earning pattern. If we think an asset is going to be more productive in its earlier years, it will generate more revenue during this period. It is consuming more of its revenue capacity at the start, so the reducing balance should be used. We allocate more depreciation in the early years and less as it gets older. If the asset is expected to have a constant revenue earning pattern, it is going to earn the same amount of revenue per period, we use the straight line method and we allocate the same amount of depreciation expense per year. So how can we summarize this? Constant revenue regardless of age, straight line depreciation is used. More revenue in earlier years of its life than later, reducing balance. But remember, 99% of questions in your textbook and exams will tell you which one to use, and future videos I will explain to you how to record using these different methods of depreciation. So now's the time to think your last part of this video. Which depreciation methods do you use for these 6 items? Importantly, as you are thinking this, just remember business may use different methods for different classes. Businesses can use straight line for some, reducing balance for other assets, but we should apply it consistently to ensure comparability. We can't change the way we depreciate a certain asset halfway through because it's going to help our reports. That's not going to faithfully represent. So have a think about these 6. Are these ones that generate more revenue at the start, or is it constant? A way I like to think of it is, are there lots of moving parts in this asset that is going to make it more efficient at the start when it is new and shiny and efficient? And is it going to get less efficient as we move on? And hence, if that's the case, it's going to generate more revenue at the start, and maybe reducing balance is better. So which ones of these have the most moving parts? Definitely a vehicle, definitely forklifts and machinery, and maybe a computer. Which ones have not much moving parts, are really just stagnant assets? Definitely your office equipment and maybe your display equipment. So reducing balance is almost certainly more appropriate for the vehicle, machinery and forklifts, and the computer might be a tough one. But the equipment and display equipment, less moving parts, doesn't matter. The efficiency is less important. So we're going to probably use up this asset at a constant rate, as opposed to the other ones, which are going to be less efficient, less effective at making revenue as they get older. And guys, that is our introduction to depreciation. Hopefully you now can define depreciation, understand how to determine the cost of assets, and start to appreciate the difference between straight line and reducing balance. Future videos, there will be 2 of them, will explain how we record and calculate depreciation using straight line and reducing balance, but that is for a future video. Well done for beginning to learn about depreciation, how we record it in our accounting system.